Japan's bond market just broke, not cracked, broke. And the US Federal Reserve responded by directly intervening in currency markets to support the yen. That doesn't happen unless someone with access to classified data is genuinely terrified about what comes next. This isn't a routine central bank cooperation press release. This is the financial equivalent of calling in air support because the ground is collapsing. On January 19th, 2026, something shifted that hadn't moved in 3 decades. Japan's 30-year government bond yields spiked to 3.9%, the highest level since these securities were created. The 40-year bonds crossed 4% for the first time since 2007. Yields on 20-year notes jumped 22 basis points in a single trading session. For context, bond traders describe moves like this as Six Sigma events, occurrences that statistically should happen once every few million years. Yet here we are, watching it unfold in real time. You might be wondering why a bond market sell-off in Tokyo matters to your portfolio. Fair question. Here's the answer. Japan holds $1.2 trillion in US Treasury bonds, more than any other foreign country. For 30 years, Japanese institutions have been the single largest external source of demand for American government debt. They've been the buyer when nobody else showed up. That arrangement just became mathematically unsustainable. The entire global financial system has been quietly held together by one extraordinarily profitable trade. Borrow yen at 0% interest, convert those yen to dollars, buy US treasuries yielding 4% to 5%, collect the spread, rinse and repeat for 3 decades. This is called the carry trade, and it's been the foundation beneath everything. Stock valuations, real estate prices, cryptocurrency rallies, all of it was built on an ocean of cheap Japanese funding flowing into higher-yielding assets around the world. But the math just broke. Japanese government bonds now yield between 2% and 3.9%, depending on maturity. So ask yourself this. If you're a Japanese pension fund manager, why would you take currency risk, send money overseas, and buy US treasuries at 4.8% when you can buy Japanese bonds at home yielding 3.7% with zero exchange rate exposure? You wouldn't. Nobody would. The risk-adjusted return disappeared overnight. What triggered this? Japan's new Prime Minister, Sanae Takaichi, announced a 21.3 trillion yen stimulus package on January 19th. She called a snap election for February 8th to secure a mandate for what she's calling Sanae economics. Tax cuts, massive infrastructure spending, abandoning decades of fiscal restraint. Markets took one look at Japan's debt-to-GDP ratio, already sitting at 240%, the highest in the developed world, and decided they'd seen this movie before. The UK nearly imploded in 2022 when Liz Truss tried unfunded tax cuts. British pension funds almost went bankrupt. Japan's version is playing out on a much larger scale. The Bank of Japan made everything worse by raising interest rates to 0.75% in December, the highest level since 1995. That might sound like nothing, but it's a seismic shift for a country that had negative rates for years. They've also abandoned yield curve control, the policy where they artificially capped long-term rates by buying unlimited quantities of government bonds. They were the buyer of last resort. They've now stepped back. And without that artificial suppression, bond prices are discovering their true level. Investors don't like what they're finding. Here's where this goes from interesting financial news to this will destroy unprepared portfolios. Hedge funds saw the carry trade and thought, if we can make 4% to 5% risk-free, what happens if we leverage it 10 times? 20 times? They did exactly that. Nobody knows the precise figure because hedge funds don't report positions publicly. But estimates from major banks suggest the total leveraged carry trade could be $15 trillion to $20 trillion in notional exposure. That's not a typo. 15 to 20 trillion in bets that are now underwater and have to be closed. And We already got a preview. In August 2024, the Bank of Japan surprised markets with a small rate hike. The carry trade started unwinding. Bitcoin crashed 23% in 3 days. The Nasdaq dropped 10%. The S&P 500 fell 8%. $2 trillion in market value evaporated in 72 hours. That was a tremor. What's building now is the full earthquake, because the rate moves are larger, the positions are bigger, and there's no easy way to stop the unwind once it starts. When hedge funds get margin calls, they don't carefully evaluate which assets to sell. They dump everything liquid. Stocks, bonds, crypto, commodities, anything that can be converted to cash immediately to cover losses. Your tech stocks get sold, not because Apple or Microsoft are failing, but because a hedge fund in London needs to raise $500 million by market close to meet margin requirements on a blown-up yen position. This is indiscriminate forced liquidation. And it gets worse. According to Bank of America, half of all major institutional money managers currently have zero downside protection in their portfolios. No hedges. Fully long, completely exposed. Everyone is on the same side of the boat. When everyone tries to exit simultaneously, the boat capsizes. But the real danger isn't just Japan. Europe holds approximately $3 trillion in US Treasury bonds, triple what Japan owns. European governments are facing enormous pressure to increase defense spending because of Ukraine and US demands for 3% to 4% of GDP on military budgets. Where will they get that money? They'll sell assets. And one of the most liquid assets European institutions hold is American government debt. The US Treasury Secretary was asked about this crisis at Davos. His response: "I've been in touch with my counterpart in Japan. I'm sure they will begin saying things that will calm markets down." Saying things, not implementing solutions, just talking. When the Treasury Secretary is reduced to hoping Japan says reassuring words to make bond markets feel better, you know there's no actual plan. Now let me explain something that almost nobody in financial media is discussing, but it's the most important piece of the puzzle. What's happening in Japan isn't just a Japanese problem. It's exposing a fundamental flaw in the architecture of global finance that's been hidden for 3 decades. The traditional diversification model is broken. In normal market conditions, when stocks fall, bonds rise, investors flee to safety, treasury prices go up, your 60-40 portfolio stays relatively stable because losses on one side get offset by gains on the other. This is Portfolio Theory 101. It's what every financial advisor has been teaching for 50 years. But when the creditworthiness of governments themselves comes into question, that relationship shatters. Stocks fall because of forced liquidation and economic stress. Bonds fall simultaneously because nobody wants to hold government debt at current yields when rates are spiking and fiscal sustainability is uncertain. Both sides of your portfolio decline together. The hedge disappears. You're not diversified. You're just exposed everywhere at once. We saw this exact scenario play out in the United Kingdom in 2022 during the Liz Truss government crisis. British pension funds, which were supposedly conservatively managed with diversified holdings, nearly went bankrupt because their stocks and bonds both crashed simultaneously. The Bank of England had to launch an emergency intervention to prevent total systemic collapse. Ken Griffin, founder of Citadel, one of the largest and most sophisticated hedge funds on the planet, just issued a direct warning about this. Bonds lose what makes them special in a portfolio when bonds and stocks move together in prices. Translation: your traditional hedge is gone. Your carefully constructed 60-40 portfolio is now 100% directional risk. And here's what makes Japan's situation particularly dangerous as a trigger. The country has maintained artificially low rates for so long that the entire global financial system built positions assuming Japanese rates would stay near zero forever. Pension funds structured their liabilities around that assumption. Insurance companies built investment strategies on that foundation. Hedge funds leveraged that stability to amplify returns. When that assumption breaks, when Japanese rates normalize upward even slightly, the ripple effects aren't contained to Japan. They propagate through every interconnected market, because the carry trade wasn't just a Japanese phenomenon. It was the hidden subsidy keeping global asset prices elevated. Let me be very specific about the chain reaction. Japanese rates rise. Japanese bonds become attractive relative to foreign bonds on a risk-adjusted basis. Japanese institutions stop buying US treasuries and start bringing money home. Demand for US government debt falls. US Treasury yields spike to attract new buyers. Higher US yields mean higher borrowing costs across the entire American economy. Mortgage rates rise. Corporate borrowing costs increase. Stock valuations compress because future cash flows get discounted at higher rates. Real estate prices fall because affordability collapses. And this is already happening. The 30-year US Treasury yield hit 4.93% recently, approaching the critical 5% threshold. The 10-year yield jumped to 4.29%. These moves happened in direct response to the Japanese bond market chaos. The correlation is undeniable. But most investors don't understand why this matters to them personally. They think government bond yields are some abstract thing that happens in financial news. Here's why it directly impacts your wealth. Mortgage rates are tied to long-term treasury yields. If the 10-year treasury goes from 4.3% to 5.5% or 6%, your 30-year fixed mortgage rate, currently around 7%, could easily hit 8% or 9%. Housing demand collapses at those rates. Prices fall because buyers can't afford payments. Your home equity gets destroyed even if you're not selling. Corporate debt refinancing becomes a nightmare. Companies that borrowed cheaply over the past decade now face dramatically higher rates when those bonds mature. Some will default. Their stocks will crater. Your 401k, which owns these companies through index funds, takes the hit. Tech stocks, which have driven market returns for years, get hit especially hard. Growth companies are valued based on future earnings discounted to present value. When discount rates rise, those valuations collapse mathematically. It's not about the companies failing. It's about the math changing. What about the investors who think they're safe because they're holding cash? This might be the most dangerous misconception of all. Cash feels safe. It's not moving. There's no volatility. But cash is going to get destroyed by what comes next. When this crisis reaches its peak, when treasury markets are in disarray and financial conditions are tightening dangerously, the Federal Reserve will face an impossible choice. Let the system break, allow deflation and mass defaults, which is politically unacceptable, or restart quantitative easing, print trillions to stabilize markets, and accept the inflationary consequences. They'll choose option 2. They always do. And when they print trillions to bail out the system, your cash loses purchasing power rapidly. The dollar weakens. Inflation spikes. You're sitting in what feels like safety while your wealth quietly evaporates. So where does that leave you? What's the actual strategy when traditional diversification fails? When both stocks and bonds can fall together? When cash gets debased? You need to think in terms of hard assets and essential businesses. Things that hold value or generate necessary cash flow, regardless of what currency does or what interest rates do. Energy companies. People need oil and gas regardless of economic conditions. These businesses have pricing power and pay dividends. Precious metals. Gold and silver aren't someone else's liability. When government debt is in crisis and currencies are unstable, metals hold value. Quality technology with fortress balance sheets. Microsoft, Apple, Google. These companies generate massive free cash flow, have minimal debt, and provide essential services. They survive. Consumer staples, Walmart, Procter and Gamble, Coca-Cola. People still need to eat, clean, and buy basics even in a recession. These businesses are recession resistant. What you absolutely must avoid are the sectors that get annihilated in this environment. Regional banks sitting on massive unrealized losses from bond portfolios. More will fail if rates spike further. High-debt companies with refinancing coming due, they're facing bankruptcy when they have to roll over cheap debt at much higher rates. Speculative technology with no profits. These companies were funded by cheap capital. When capital gets expensive, they die. Consumer discretionary and luxury goods. When people are worried about money, they stop buying things they don't absolutely need. The next layer of risk almost nobody is talking about comes from Europe. European governments and institutions hold approximately $3 trillion in US Treasury bonds. That's triple what Japan holds. And Europe is broke. Germany just announced its largest defense spending increase since World War II. France is facing political chaos and widening deficits. The UK is dealing with stagflation. Every major European economy is being pressured to dramatically increase military spending because of Ukraine and NATO commitments. Where does that money come from? They're going to sell assets. And the most liquid, largest asset European governments hold is US Treasury bonds. So you've got Japan selling because the math no longer works for the carry trade. You've got Europe selling because they need cash for defense spending. And you've got the US Treasury issuing record amounts of new debt to fund its own deficits. Supply is exploding. Demand is collapsing. Bond prices fall. Yields spike. And the entire system built on cheap government debt breaks. Now let me give you the specific warning signs that tell you this crisis is accelerating beyond the point of control. These are the levels you need to watch. US 10-year Treasury yield above 4.75%. We're at 4.3% now. If it breaks 4.75%, that's your signal that foreign selling is overwhelming domestic demand. The Treasury market is losing its anchor. US 30-year Treasury yield above 5%. This is the crisis threshold. Long-term rates at this level mean the market is pricing in either much higher inflation or serious doubts about US creditworthiness. Neither is good. Dollar-yen exchange rate below 140. If the yen strengthens rapidly, it means carry trades are unwinding fast. Japanese money is coming home. Dollars are being sold. Yen is being bought. VIX volatility index above 30. This measures market fear. Above 30 means institutional panic is setting in. Positions are being liquidated regardless of price. These aren't predictions. These are mathematical tripwires. When they break, the system moves from stress to crisis. You'll know it's happening because all of them will trigger within days of each other. Markets don't break slowly. They break all at once. So what's your actual move? How do you position for something this large and this unavoidable? First, you need to accept that this isn't about getting rich. This is about not getting poor. Wealth preservation is the only realistic goal when systemic deleveraging happens. You want exposure to sectors that hold value when everything else is repricing. Energy remains essential regardless of economic conditions. Exxon, Chevron, these companies generate cash flow, pay dividends, and have pricing power. Materials, specifically precious metals. Gold is hitting all-time highs right now for a very specific reason. When government debt is questioned and currencies are unstable, gold becomes the safe haven that actually works. GLD for gold exposure, SLV for silver. These aren't speculative plays, they're insurance. Quality technology with fortress balance sheets. Microsoft, Apple, Google. These companies aren't going anywhere. They generate massive free cash flow, carry minimal debt, and provide services the world can't function without. They'll survive and likely emerge stronger. Consumer staples. Walmart, Procter & Gamble, Coca-Cola. People still need food, cleaning supplies, and basic goods even during recessions. These businesses are recession-resistant by nature. You also need to understand position sizing in this environment. This isn't about going all in on any single thesis. Allocate 10% to 20% into hard assets like gold and silver. These are your hedge against currency debasement and government debt crisis. Keep 30% to 40% in quality defensive equities. Energy, staples, fortress balance sheet tech. These generate cash flow and hold value. The remaining 40% to 50% can stay in traditional diversified holdings, but understand that this portion is at risk. It's your bet that the system doesn't completely break. But you're not concentrating everything there anymore. The most important psychological shift you need to make is this. Hope is not a strategy. The Treasury Secretary hoping Japan says nice things to calm markets is not a plan. The Fed hoping this resolves itself is not a strategy. You cannot rely on authorities to fix this because they're out of tools. Interest rates are already high. They can't raise them further without breaking everything. They can't cut them without reigniting inflation. They can't restart QE without destroying the dollar's credibility. They're trapped. And when central banks are trapped, markets resolve the imbalances themselves. That resolution is painful, fast, and indiscriminate. Japan's February 8th election is the immediate catalyst everyone should be watching. If Prime Minister Takaichi's coalition wins and doubles down on massive fiscal spending with Japan's debt already at 240% of GDP, bond markets will revolt further. If she loses, uncertainty creates volatility anyway. There's no good outcome that calms this down. Ken Griffin from Citadel, one of the most sophisticated investors on the planet, just called Japan's bond sell-off an explicit warning to the United States. His exact words, "The bond vigilantes can come out and exact their price. You need to get your fiscal house in order." When billionaire hedge fund managers are publicly warning about bond vigilantes, you know the professionals are already positioned defensively. This crisis is mechanical. It's math. The carry trade math broke. Japanese investors will sell US treasuries because the risk-adjusted return disappeared. Hedge funds will unwind leverage positions because they're losing money. Bond yields will rise because supply overwhelms demand. Asset prices will fall because liquidity is draining from the system. None of this requires a conspiracy or a crash or a dramatic headline. It just requires math to resolve itself. And math always wins. The next 90 days aren't a countdown to some theoretical future crisis. They're the window where positioning still matters, where you can still make decisions before decisions get made for you. After that, you're just reacting to prices that already moved, losses that already happened, opportunities that already closed. This isn't about predicting the exact day everything breaks. It's about understanding that the math already broke and watching the consequences unfold in real time. Japanese bond yields at 30-year highs aren't going back down. The carry trade that funded 3 decades of global asset appreciation isn't coming back. Hedge funds sitting on underwater leverage positions aren't going to hold them forever, hoping for a miracle. The unwind is happening. The only question is how fast. You can't stop systemic deleveraging once it starts. You can only decide whether you're positioned to survive it or positioned to get destroyed by it. Most investors will do nothing, convinced this is just another headline that will blow over like every other headline. They'll stay fully long, fully exposed, holding the same 60-40 portfolio that worked for 40 years, not realizing the rules just changed, and they'll watch their wealth get cut in half over the next 12 months, wondering what happened. The market doesn't care about your plans, your retirement timeline, or how close you are to your goals. It only cares about math. And right now, the math says something that held the system together for 3 decades just broke. What comes next isn't a mystery. It's just math resolving itself. The only variable is whether you see it coming.